Imagine a modest, even rundown home in San Francisco, London, or Amsterdam, with a staggering price tag of over $1 million. This is no longer an exception, it's becoming the rule. Housing prices across the whole globe have reached levels many would consider absurd, putting ownership out of reach for millions. In this episode, we'll explore the economic mechanisms behind this trend, focusing on the US and Europe. We'll draw on economic theory to explain why this is happening and what it means for society and future generations. Since the 2008 financial crisis, central banks have implemented historically low interest rates and expansive monetary policies to stimulate economic growth. While this made borrowing a lot cheaper, it also encouraged speculative investment in real estate. So investors, flush with capital, began treating housing not as a shelter, but as a financial asset. This influx of easy money inflated housing prices well beyond income growth. As quantitative easing injected liquidity into markets, real estate became one of the safest and also most profitable places to park capital, especially in urban centers across the US and Europe. At the heart of economic theory is the principle that prices rise when demand exceeds supply. In housing markets, this mismatch has been severe and prolonged. On the supply side, there are numerous constraints: zoning laws, land use regulations, environmental approvals, and community resistance to development. Now, if we look at the demand side, there's not only population growth and urbanization, but also we have speculative investment. The result, you may ask? A system where supply growth is slashing, but demand continues to surge, pushing prices upwards in both booming economies and stagnant ones alike. Major cities like London, New York, Paris, and even Amsterdam has seen an influx of global capital targeting real estate. High-end developments are increasingly designed not for the residents, but for international investors looking for secure returns. Foreign buyers, megalords, and corporate firms now dominate the real estate markets in the prime locations. This financialization turns homes into a wealth storage, disconnecting housing prices from local income levels. Locals are basically priced out, while properties sit empty, not for living, but as financial instruments as a global investment strategy. One of the less discussed but critical reasons for the housing crisis is chronic underbuilding. After 2008 financial crash, many developers halted construction, and the industry has struggled to rebound. In the US alone, estimates suggest a shortage of over 3 million homes. Skilled labor shortages, restrictive zoning, and rising construction costs all contribute to this stagnation. Meanwhile, demand has grown steadily, especially in metropolitan regions. Without significant increases in housing supply, price pressures are likely to persist or even worsen. In many European cities, regulations like rent control and strict planning laws were introduced to protect tenants, but have also had unintended consequences. By capping rent prices, landlords are discouraged from investing or maintaining their properties. Some choose to exit the rental market entirely. At the same time, supply is further constrained by complex approval processes. This leads to a paradox. Cities are trying to protect affordability while implementing policies that restrict the supply needed to achieve this. Berlin, Paris, and Amsterdam are all facing this trap. Over the past 2 decades, housing has been increasingly treated as a financial asset rather than a social good. Real estate investment trusts, hedge funds, and global investment firms have poured billions into residential property. This commodification of housing has led to price inflation, decreased affordability, and of course, this results all in growing inequality. When homes are treated like stocks, the link between wages and prices breaks down. Investors seek returns, renters seek for shelter, and increasingly, the system favors the former over the latter. While housing prices have soared, wages have lagged far behind. In both the US and Europe, real income growth has been modest at best. As a result, younger generations, specifically millennials and Gen Z, face an affordability crisis. Home ownership is delayed or even abandoned. This leads to long-term rent dependence and rising financial insecurity. The wealth gap between those who own property and those who don't continues to widen, reinforcing intergenerational inequality and economic stratification. With prices at record highs and incomes stagnant, many economists are warning of a potential housing bubble. Central banks have started raising interest rates, which could cool down markets but may also trigger defaults. The debate is ongoing. Are current prices justified by fundamentals, or are we heading towards a correction? If interest rates continue to rise and wage growth remains slow, the condition for a market adjustment become more likely, especially in overheated markets with an high investor presence. Solving the housing crisis will require a multifaceted approach. Policymakers must address supply constraints by reforming zoning laws and incentivizing construction. Regulatory frameworks should balance tenant protections with market viability. Taxing vacant properties, restricting speculative investment, and investing in public housing can also help. But more than policy, the solution lies in a cultural shift, redefining housing not as a community, but as the human necessity that it is. Only then can we move toward a system that offers shelter, stability, and dignity for all.